And from global growth to global markets, the International Monetary Fund is now warning that the sell-off we've seen so far this week could be a picture of what's to come in 2022. The IMF's financial counselor is predicting that as central banks around the world move to pull back on easy monetary policy and increase interest rates, markets will be directly affected.
But if you've paid attention to markets this week, you know that the turbulence is already here. There are a number of factors at play, from a crucial Federal Reserve policy meeting to earnings season in full swing to geopolitical tensions leading to threats of sanctions and export controls. There is truly a lot going on in the world, and markets are feeling the heat. So to go further in depth on this, let's bring in Michelle Snyder, partner and director of trading research and education at the Market Gauge Group, and Charles Mizrahi, founder, alpha investor, and host of the Charles Mizrahi Show. It's great to have you both on the show today. Now, Michelle, let's start with you. What do you see as having the biggest impact in markets here in the U.S. this week? I mean, do all roads lead back to the Fed and their plans for the year?
It is a road, but I don't know if it's the only road, because there were signs that the market was going to possibly be in trouble, even starting in November of 2021, as we were into the whole Black Friday big retail thing. We saw that people were buying in advance and then not necessarily so robust. People were expecting things to happen because of Omicron. And now I add to that the Fed talking hawkishly, but saying really nothing definitive yesterday. I think it's more the anticipation. And then we have this really strong dollar. Then, of course, as you mentioned earlier, we have the Russian situation also happening. The whole thing really is setting the stage for a stagflation environment. That's where we've been talking about heading for 2022. It looks like that's what we're heading, even though some commodities have come off. The Fed has definitely made an impact. But at this point now, I think it would behoove them to be too aggressive, considering even beside the GDP being strong, it still doesn't really reflect what's going on, which is a shrinking economy.
I certainly think a lot of people would agree with you on they would like to see a more aggressive Fed at this point. Now, Charles, what do you make of that claim from the IMF that the turbulence we've seen over the last week or two is likely to be that new normal for 2022? Are the record highs we saw over the last several years, are they officially over?
All right, so two good questions. One is I don't look to the IMF to make predictions or forecast how and where markets are going, because they have no greater insight than you or I. Forecasting and predicting markets and economies, as we've seen in 2020, is really worthless. Is the market going to make new highs, or these last highs? I really couldn't tell you. My crystal ball is broke. But all I can say is this, is if you're investing in the stock market, you're buying a piece of a business. Stock really is. And these short-term gyrations over geopolitical events as well as interest rates should not have a major bearing on what you do next week or next month. If you're looking for the long term to buy great businesses at great prices, now's a great time.
And that's something we've obviously heard a lot from people, is saying, hey, this is when you make the money. When markets go lower, that's when you're going to start to actually make the money. But it is a concern because you're absolutely right. Although there are times where we see maybe the market doesn't necessarily line up with exactly what that business is. I mean, we've seen about 74%, at least as of earlier this week, of S&P 500 companies have actually reported positive earnings, beating expectations. But still, we've seen what we've seen happening in the markets this week. Now, Michelle, when it comes to those earning reports, typically beating estimates is a positive, but we've seen companies like Intel and GE where their fourth quarter earnings were more than expected, but their stock actually went down based on the outlook for this year. What does that tell us?
Well, exactly that, is that there's one thing about meeting an expectation or exceeding an expectation, but then there's the forward guidance. And everybody can see the macro picture. So just on the comment of this is the time to buy stocks, you really have to have some technical information there and some overview of what's going on in the general macro. And that's what GE's been talking about. They were talking about the fact that they have inflation concerns. They're still here. Their still prices went up, trucking costs, transportation costs, everything has been affecting their wind business, and the same thing with Intel. They also are dealing with supply chain issues and labor issues. The demand for semiconductors is unprecedented, but yet there's no supply to meet the demand. So you've got this perfect trifecta that's affecting most of these companies, and that is inflation, supply chain, and labor, and that's going to take a while for it to sort out.
Yeah, certainly those issues are ones that we've seen across the board. Now, Charles, we know that it has also been a week of rising geopolitical tensions with talks involving the U.S., Russia, and Ukraine. But are those tensions having an impact on markets at all this week, and why do you think that is?
I really can't speak to short-term events, what's going to happen in a week or a month or what happened yesterday, because over time, if you buy great companies at bargain prices, you'll do well. Did anyone remember what the geopolitical events or the interest rates were in 1965 when Berkshire Hathaway went public, or in 1970 we're in the midst of the Vietnam War with Walmart, or 1997 with Amazon? Find great companies. This isn't a difficult game. It's a pretty simple game. Find great companies, buy them at bargain prices, and then sit on your butt and ignore all of this short-term noise, because that's all it is. And earnings reports are just a picture of a company over a 13-week period. So why would anyone make a long-term decision based on what happened over the past 13 weeks?
Well, I mean, I think what I think a lot of people say is that you see how they weathered that storm for when it comes to supply chains, when it maybe is in the
13
situation.
weeks? 13 weeks? Well, Walmart missed many retail expectations over the past 50 years. Did that prevent you from making millions of dollars on a $1,000 investment? Same thing with Amazon, same thing with Berkshire. Companies just don't go straight up. If we look at this game on a moment-by-moment basis, you'll go crazy, because that's not the way you invest. You trade that way. You don't invest that way.
Yeah, there's certainly a lot to pay attention to there, and we will keep an eye on it moving forward. Michelle Snyder and Charles Mizrahi, thank you both for joining us today.